Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Despite 3 recessions in 9 years, double-digit unemployment, and 2 stock market crashes, the mid to late 1970s and early 1980s witnessed the highest inflation since the end of World War II. By 1981, inflation had reached 15%, and interest rates were raised to 20% to combat the inflation. When Paul Volcker was appointed Fed chair in 1979, he immediately set about ending the worst inflation the U.S. had seen since the end of World War II by raising rates. Then, the U.S. was hit with a recession in January 1980, and Volcker was under intense pressure to cut rates in the face of a recession and layoffs. He blinked. Volcker lowered the Fed funds target rate by 7 percentage points. The recession was over by July 1980, but inflation was not. The Fed and Volcker had damaged their credibility as inflation fighters. This became known as the infamous Volcker mistake. Powell does not want to repeat the Volcker mistake. He knows how that turned out and doesn't want to end up in the history books for making the same mistake. However, Powell is on exactly the same path Volcker was on before he saw the light. Can we trust that Powell is seeing the same light, and maybe just as importantly, has he the will and fortitude Volcker had was called upon? As I am sure you have often heard, history doesn't repeat itself, but it often rhymes. Having started my professional career in the early 1970s, it was a decade I clearly remember. I joined IBM right out of university and was engaged in marketing, sales, and installation of computer systems to a world only beginning to adopt computer technology. I was involved in endless consultative selling sessions, trying to convince corporations to adopt the new technology in their fight against relentless rising costs. Every presentation talked about inflation in some way or the other. That focus lasted for a decade and went through differing stages, but was always, nevertheless, ever present. There were 3 waves of inflation, waves that were as much about learning how to handle it as fiscal policies and geopolitical events that were occurring. The first stage actually began in the late 1960s, as shown here. It was about the U.S. using its credit card for the first time to finance major social changes and a war. President Johnson's Great Society did not dramatically raise taxes to finance his Great Society, nor did the Vietnam War ask taxpayers to buy war bonds as it had always previously done. Rather, the U.S. just printed the money without the requisite gold backing to support it. This led to the inflation spike that took inflation to an eventual high of 9.2%. The only way perceived to stop it was to raise rates through increasing the Fed funds rate. The Fed funds rate was steadily increased to halt inflation until it reached 6.2%. Rates at that level drove the economy into the recession of 1970. Disinflation and deflation took control, and the Fed followed by immediately lowering the Fed funds rate. The Fed's funds rate, as you can see, actually led the drop in inflation, but failed to halt the economy from worsening until the inflation was 1/3 of what it had been. Subsequently, in August 1971, President took the U.S. officially off the gold standard as he tried desperately to fiscally revive the economy. The U.S. then experienced a second round of inflation from 1972 until 1975 as the official inflation measure. The Consumer Price Index, or CPI, rose from 3.3 to 11.1%. This was nearly twice the peak experienced in the first wave. The oil embargo of 1973 to 74 pushed prices of petroleum from $15 to $45 a barrel in 2010 dollars almost overnight. This certainly contributed to the renewed inflationary measures during this period, taking a larger share of incomes, an oil tax if you would, at a time of falling consumer spending. During this period, the Fed, now chaired by Arthur Burns, once again attempted to rein in inflation by aggressively hiking the Fed funds rate. This time rates were taken into the 12% range, before once again taking the U.S. into yet another recession. Again, this forced the Fed to take rates down quickly to fight the recession of 1975 to 1977. The CPI only fell to 5.7% this time in 1976, before rebounding and eventually peaking at 13% in 1980. Burns was replaced by William Miller as Fed chairman in 1978, but Miller only lasted a year, as his efforts to end inflation proved similarly futile. The Fed again raised rates from 6.75 to 10.5% during Miller's tenure, but inflation continued to rise from 7.6% to 11.3%. As I mentioned earlier, when Paul Volcker was appointed Fed chairman in 1979, he immediately set about ending the worst inflation the U.S. had seen since the end of World War II by also raising rates. Once again, the U.S. is hit with a recession in January 1980, and Volcker was under intense pressure to cut rates in the face of a recession and layoffs. Volcker capitulated and lowered the Fed funds rate by a staggering 7 percentage points. The recession was over by July 1980, but inflation again was not. The Fed and Volcker had damaged their credibility as inflation fighters. This became known as the infamous Volcker mistake. In many ways, it was an unfortunate label, because Volcker had actually realized that he needed to both drain excess reserves and liquidity from the financial system and raise rates. It was only by doing both concurrently would he get any sustainable traction. Volcker had been president of the all-powerful New York Fed prior to assuming the Fed chair position, so he was already engaged in attempting to remove the froth from the financial system while letting rates move in a wider range in order to tighten policy to the point that inflation finally disappeared. The effect was a severe recession from July 81 to November 82, but CPI also came down, eventually falling to about 3% in 1983. From that, Volcker assumed the stellar and enviable reputation he has today. It is clear from the CPI in the 1970s that rate hikes didn't end inflation, but only by also consistently draining excess reserves did it. Volcker no doubt had serious challenges to contend with, but compared to what Jerome Powell faces today, they look rather straightforward. Chairman Jerome Powell finds himself on a precipice edge and in many ways in a catch-22. A catch-22 on multiple dimensions, which would be best described by most as simply another way of describing a trap. The Fed's total assets as a share of gross national product never approached those that Paul Volcker faced until the 2008 Great Financial Crisis. After 4 decades of the Great Moderation, we were suddenly and abruptly brought into the hard reality, the Great Fiat Gamble. We were suddenly forced into Chairman Bernanke's era of quantitative easing and enrich thy neighbor doctrine of the coordinated ring-around-the-daisy game of fiat currency debasement. The gamble brought us another decade, but took the U.S. and global debt levels well past the 90% of GDP, so well documented by Reinhardt, and Rogoff, as a level at which GDP can be expected to start contracting because servicing of the debt historically has then been shown to restrict investment growth. This is a problem since that is when you must start squeezing liquidity to get inflation under control. As this chart shows in the upper right, this is what the Fed's quantitative tightening, or QT, was initially aimed at, to reduce the Fed's balance sheet and rein in liquidity. Unfortunately, it didn't take long for the Fed funds rate to break something again. This time it was the banking system in March, which was temporarily contained to give the Fed more time to fight inflation. The Fed funds rate now trades around 5.5%. More breakage is to be expected as the U.S. commercial real estate market is currently under heavy assault. The Fed isn't going to get the rate much higher for much longer before a recession again takes the bottom out from under it. Our prior charts of the 1970s conclusively shows that is what we should expect, and it is what we're seeing in the daily economic reports that we show in our weekly newsletter. As well, everyone is front-running the expectations of a Fed pivot, with rates anticipated as heading lower. But oh, if it was only that simple. The world has come to totally depend on the U.S. consumer and its 70% consumption economy financed by deficit spending. Fiscal deficits, by which current account and balance of payments accountings drive global growth and the Eurodollar system. It is called the Triffin paradox. A sick U.S. can quickly become a pandemic for the rest of the world. Lowering rates doesn't fight inflation. A growing Fed balance sheet doesn't reduce liquidity. Too much growth in the Fed's balance sheet and the dollar comes under attack and inflation hits. Too slow a change in either and the recession leads to unemployment and attacks social entitlement funding. Both together create even a greater debt burden load. Too fast a reduction of Fed funds rate and the recession becomes deeper and longer. Too fast a reduction of Fed funds rate and real rates come under attack, which makes attracting foreign debt financing more difficult and more expensive. If anything breaks while this balancing act is attempted, It'd be like a strong gust of wind occurring while doing a high wire act. Your chances of survival are slim to none, a position the U.S. and world has never been in before. An unexpected gust of wind can take many forms, but are all potential Powell poison. Unfortunately, Powell must worry as much about the global economy as the U.S. This chart from December 2022 shows the combined total assets of the Fed, ECB, and Bank of Japan. The monetary actions of these three countries shows in the upper right corner as the Fed began quantitative tightening, or QT. As the consolidated balance sheets were taken down, the market contracted from the removal of liquidity and tightening bank and lending credit standards. This was as needed to fight inflation. But something happened at the beginning of this year and accelerated in March. This year they stopped moving together. Liquidity has gone down year to date, but the S&P 500 has gone up, way up. From December 2022 to June 2023, the combined total assets fell by $840 billion, or about 4%, whereas between December 2022 and July 25, 2023, the S&P 500 rose by 730 points, or 19%. This divergence from the normal pattern could be 1. A warning signal that the stock market has gotten ahead of itself and is at risk of a great tumble, or 2. The surge in the S&P could simply reflect a great improvement in expectations for fundamentals resulting from the AI revolution, which we identified in January when NVIDIA and the Magnificent Seven began taking the markets higher, or 3. The stealth liquidity pumping that came from the Bidenomics stealth liquidity pump. I've described this pump in our weekly newsletter. It basically used the banking crisis and its BTFP to stabilize banks against deposits withdrawals, which were invested in money market funds, which reduced the Fed's reverse repo hold at the Fed, and they bought Treasury bills with that money needed to fund the Treasury's General Account, or TGA. This created a spike in liquidity, initially seen in a temporary surge in the Fed's balance sheet before stabilizing with the resolution of the debt ceiling increase and the replenishment of the TGA. Bidenomics is pumping liquidity in the form of modern monetary theory, or MMT, through this approach. Student loan forbearance extensions, income tax referrals, and direct green energy subsidies that place money directly in the hands of the consumer without being lent into existence through the lending and banking facilities. Bidenomics is about getting reelected and is completely devoid of a full appreciation of caring about what Volcker so painfully learned and Powell is very much cognizant of. Bidenomics in the short term is manipulating the system for political advantage. This is to be expected if this was business as usual and not the situation we find ourselves presently in. Joe Biden is playing the well-rehearsed script he has learned over the past 40 years, but it is completely the wrong script for today's environment. Fiat currencies are in serious trouble as China, Russia, Saudi Arabia, and the various BRIC alliances gain power to combat the weaponization of the U.S. dollar as a political weapon, as the U.S. takes full advantage of the exorbitant privilege of the U.S. dollar to take on debt at the world's expense. Though this chart is dated and doesn't reflect the massive increases since COVID and the $7 trillion of Bidenomics, it does illustrate that debt is now overpowering global economy's abilities to sustain itself with real economic growth. The reality is that all fiat currencies have historically failed, and we are well on that road as global debt levels become unsustainable and, frankly, inextinguishable. The evidence is all around us if we care enough to actually look. As we move towards the next block in the up corner entitled Failure, we will likely go through the stages outlined here. We laid these out in this year's thesis paper available on our site. The red box in the area we are currently operating in as we move towards hyperinflation in the bottom right of this representative schematic. The coming inflation will bring further disinflation, but we will see continued inflation in the things we need and need cash to pay for, with deflation in assets we borrow to finance. The big tsunami wave of inflation is still in front of us. The conclusions are pretty clear. We're highly likely going to repeat the 1970s unless we alter course quickly. The waves are going to be driven slightly differently and are highly likely going to be much more dramatic and impactful. Chairman Powell will do all he can, but he needs a White House that isn't just setting him up for failure. The one thing that is given about Bidenomics is that it always immediately blames someone else for its policy blunders. Powell and the Federal Reserve is being set up to be a fall guy as the administration reaches for more power during the inevitable crisis ahead. It is all right out of the Marxist Manual for Revolution, as President Barack Obama and then Vice President Joe Biden so well practiced, and I quote, "Never let a crisis go without taking full political advantage of it." And that's what's going on right now. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will actually take that money or it is no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and overall global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments typically are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.